Hello and welcome back to tax class. This evening we want to talk about filing status and dependency, and I guess you might not be listening to this in the evening. So, filing status and dependency for the topic today. Yeah, I'll let you read the quote there, kind of a humorous quote from Will Rogers. Of course, there's all kinds of quotes about the tax code, and I'll share a few of them with you along the way here. So first we want to jump into some administrative items. And the first of those is, when do you need to file a tax return? And so the general rule of thumb here is, if your income is below your standard exemption or your standard deduction plus your exemption, you're probably not required to file a return. So as a single taxpayer in 2016, that would be $6,300 for the standard deduction and $4,050 for the exemption. So if my math is correct, if you had income less than $10,350, you would not be required to file a tax return. Now, if your filing status is something other than single, which we'll get into here as we work through the presentation, that amount may be different if you're married filing joint, for example, or head of household. But that's the general rule. Now, there are some reasons why you might want to file a tax return anyway. For example, you have some wages and somebody has withheld federal income tax or state income tax from your paychecks. The only way to get that money back is to file a tax return and request a refund. It is also possible that you may be entitled to um, some refundable tax credits, such as the earned income credit, the additional child tax credit. There may be educational credits that are refundable. And so, in order to receive those refunds, you would probably need to file a tax return. And additionally, sometimes you file a tax return even if you're not required to file, to start the statute of limitations running. So most tax returns have a 3-year statute of limitations, and so by filing a return, you start that period counting. If you were to not file a return, wouldn't necessarily be a problem, but the statute of limitations is always open on a year where you have not filed a tax return. So I don't know, maybe you have very mild income and you're not required to file a return, but you sold a personal residence during the year. The proceeds from that or the gain from that is excluded and is not taxable. And so maybe you wouldn't necessarily need to file a return, but you might decide to file a return to show the sale of your home, to show that it's excluded, and to start the statute of limitations on that particular transaction and tax return. So there are times and situations when a person is unable to file their tax return. Maybe they're missing some documentation, or they're trying to track down some data, or sometimes they just have not managed their time well. In that case, there are automatic extensions. You can get one for 6 months. You file the Form 4868, not the From 4868, but the Form 4868. And you should realize that this is an extension to file, but theoretically not an extension to pay. So at the time that you file an extension, you're supposed to estimate your tax to the best of your ability and remit payment at that time. If you do not, then you'll be subject to the interest and penalties for the late payment. Now, this is a little bit difficult because if you can make a pretty good estimate of doing your taxes, it's probably because you have most of the information available. And so why wouldn't you just go ahead and file your tax return? And so what we find often is that from a practical standpoint, it's kind of difficult for people to estimate their tax, because that's the reason why they're not filing. But nonetheless, you take the best crack at it that you can to try to avoid the interest and penalties, or you just realize you're going to be hit with interest and penalties. If you've had your withholdings done close, or if you're subject to a refund at the time that you get around to filing your tax return, then of course, in the case of being close, the interest and penalties would be minimal, and in the case of a refund, they wouldn't exist. So the other thing that comes up for taxpayers from time to time is how long to keep your records. And generally, this is 3 years. The statute of limitations on a tax return is 3 years from the later of when you filed it or the due date. And so you want to keep copies of your tax records at least that long. We discussed a little bit briefly last slideshow about tax fraud. And so, in the event that you have committed tax fraud, or if you have, grossly understated your income by omitting some items, then you may be looking at a 7-year statute of limitations. So, if you have a complicated return and you've had to exercise some judgment in taking positions on that tax return, then you probably want to keep it for a longer period of time. But for most of us with a fairly simple return that's pretty clean cut, then 3 years is probably an adequate amount of time. And of course, in today's world, you can probably digitize that tax return along with the source documents, put it on a thumb drive or secure it someplace, and it's no big deal to keep it for a longer period of time. And I'm a fan of that. I think shredding and getting rid of your paperwork is probably a pretty good idea. We find that digital records are indeed safer than paper records, at least according to the studies. Now, I should add here that if you are selling long-owned assets, or buying long-owned assets like stocks, bonds, real estate, or if you have what we refer to as any capital transactions, you may need to keep your records longer. And later in the term, we'll spend some time discussing capital gains and capital losses and capital transactions in greater detail, and that will make more sense at that time. So one of the next things that comes up, or one of the initial things when you're thinking about taxes, is determining a taxpayer's filing status. And these filing statuses are things like single, married filing separately, married filing joint, head of household, qualifying widow. And these are statuses that give you different standard deductions, and they also give you potentially different tax rate tables. And so they can give you a larger deduction and possibly make your tax brackets more advantageous to you. And so to determine your filing status, we're generally looking at whatever your status is the last day of the year. This is why occasionally you will hear people talking about running off to Vegas to get married, right at the end of the year. Or conversely, sometimes people will be trying to complete or finalize a divorce prior to year end so that they can file taxes independent of each other and with their new filing status. We don't do any prorating, so it's not like you were married, 10 out of 12 months. It's whatever it was the last day of the tax year. And so if you're not married, then you are single. So that's a pretty sort of clear demarcation there. It was a few years back that on a national level that same-sex marriages were recognized by the Supreme Court, and so that is pretty easy for us to deal with now also. You are able to sustain or maintain your married filing joint status in the year that your spouse dies. So let's say that a couple is married. Let's make them elderly so the story's not quite so sad. And one of the spouses dies in March. Well, for that year, the surviving spouse can still file married filing jointly, and that's just instead of looking at the status on 1231, which would be widowed in this case, we extend the married filing joint status kind of, I can't believe I'm going to say this, but maybe out of kindness. You'll never think of the tax code as being kind, but maybe it is in this particular case. And in that same vein, we have a filing status called qualifying widow, which feels a lot like married filing joint because it comes with the larger standard deduction, and it also comes with the improved tax brackets as if a person was still married. But in order to qualify for this status, you have to have a spouse who has uh, become deceased, and you must maintain a household for children or for dependents that are of child age under 17, and you haven't remarried yet. And we'll see a slide on that in greater detail in a minute. So, just jumping to that is a brief overview of the filing statuses, and jumping to the top or the masthead part of the 1040, you can see it begins there with, name, first name, last name, address, and all of that. But you can see right below that, you get to filing status, and this is sort of a check the box thing where you check that you're either single, married filing joint, married filing separately, head of household, which we didn't talk about much yet, which is a single person who's maintaining a household for dependents, but there's more to it than that, or you might meet the qualifying widower status. And so you check one of those boxes, which will determine the tax bracket schedules that you use, and then also it will determine the standard deduction that you take on the back side of the 1040. So I have dropped in here the standard deduction little, dialog box that comes from the second page of the 1040, and you can see that the single or married filing separately standard deduction is $6,300. The head of household one, which is down on the bottom, is $9,300, and then the married filing joint qualified widow is $12,600. So these are amounts that you can deduct, which will not be subjected to tax because the deduction is going to remove that from your taxable income. I guess that's all I want to say about that. Other than, I guess I do want to say one more thing. The standard deduction everybody is entitled to. Approximately 21 to 25% of the people do better by taking the itemized deduction, which are the deductions below the line, or the Schedule A deductions, which we'll spend a chapter with those later on. But your filing status kind of sets the benchmark in terms of what your standard deduction is, and then later you look to see if the itemized deductions are indeed better or more attractive. So here's a little greater discussion of the qualified widow, and I can make these slides available to those of you that are in my class through our learning management system so that you can look back at them. But basically, qualifying widow, you think of them as like, okay, they were married, a spouse became deceased, they're still maintaining a house for dependent children, that is, children that are young, and they live with you. So this is clearly a sad circumstance, right? You have a deceased person who has left a widow with young children. These children may have temporary absences, like, for example, they're in a boarding school or something like that. But for the most part, they live with you and you're trying to provide this house and you have not remarried. Then for 2 years following the year of death, so remember, in the year of death, you're able to do married filing joint anyway, but 2 years following that, you can do qualifying widow, assuming that the person does not remarry. So you have to meet these tests, but in the event that you do meet these tests, then you would have a better standard deduction and better tax brackets. So here is married filing separately. This is kind of an unusual filing status, I guess is the way I would put it. I wouldn't say that it's rare or unseen, but it's not deployed all that often. There is two situations where it kind of comes up. One is when you're trying to file a tax return and you have a spouse that's just off the grid and you can't get any information from them, and it becomes very difficult for you to put their information into your tax return because you just do not have access to it. There is a special set of circumstances that we won't get into here called the abandoned spouse rule that sort of accommodates for situations like that. But you may find yourself not being able to meet the abandoned spouse rule requirements, and so you may be sort of tucked into a married filing separately situation. A couple may agree to do this because they don't want to commingle their finances. A couple may also agree to do this because they are seeking a divorce, but they're not very far along in the process, and they find it emotionally easier to do the process separately. And you may find a situation where it ends up being economically advantageous for a married couple, particularly if you have some relatively high itemized deductions that are subject to adjusted gross income floors. And that may not mean anything to you yet, but for things like casualty losses and medical deductions on the Schedule A, they are sometimes subject to a floor based on AGI, and sometimes by breaking taxpayers apart and reducing the income of one taxpayer, thus reducing their AGI, then you may be able to capture more of those deductions. It's a little bit of a difficult calculation. It's a lot easier to do with modern software. And I would just point out that if you do file married filing separately and one of the taxpayers itemizes, then the other taxpayer must itemize. And if one takes a standard deduction, then the other must take the standard deduction. So in a lot of cases, a lot of things in the tax code here would simply be split in half. Um, that is, they would, whatever the amount is that's given in the tax code might be shared by the two married filing separate taxpayers. But there are a lot of things that are actually lost. So you can see down in the third bullet there, certain educational tax benefits, some of the credits associated with that, the child and dependent care credit, the earned income credit, and certain adoption expense credits can be lost in a married filing separately situation. And so this is an analysis that needs to be done to see whether or not in specific circumstances some benefits of married filing separately overcome the things that are lost. So we just throw those in here. Whoops. So the head of household filing status is probably the most complicated one, in the sense that a taxpayer must be single, and then they must be maintaining a household for a dependent. And this filing status gives you that $9,300 standard deduction in the year 2016, and it also gives you a better tax bracket. And so there is desire to get into this filing status, and so you're not married, single, and you have dependents. And so we have to go through a process of checking to make sure that you have qualifying dependents. And so you can see here that it could be a qualifying child or qualifying relative. We'll see in a few more slides the qualifying child, or if they're your parents, they need not live with you. So one of the things that should jump out at you here is that you can file head of household if you're supporting, say, your elderly parents. And if you have other qualifying relatives that are other than your qualifying child or your parents, then they very much need to live with the taxpayer. So we'll get into some of these, what some of these things mean. These qualifying child, qualifying relatives that help you establish the head of household situation or filing status are what we refer to as dependency exemptions. And so let's go ahead and jump into that. The most common dependents that we'll come across is simply whether it be a married filing joint set of taxpayers or a single taxpayer or head of household taxpayer will be your dependent children. So most families that are raising kids have qualifying childs, which give them dependents, which these dependents are a exemption deduction of $4,050 each in 2016. Normally we think of them as under 18, but they can extend all the way up to age 23 if they're full-time students. And I'm going to show you a diagram here in a minute that's going to show you some tests that have to be met to sort of look at these, to see whether or not a child meets the definition of a dependent. They must be a dependent, so you must provide more than half the support. They must live with you more than half the time unless they happen to be in school. So Again, they're your child, so there's a relationship test. Although there is room here to have qualifying children that have been adopted or that are placed officially in your care by a foster agency. Um, there's the age requirement that we already talked about. They need to be residents of the U.S., Canada, or Mexico. You must provide more than half the support, and then there's a kind of a situation if they can be a qualifying child for more than one person. So here's a graphic that kind of shows those tests in, it's not real, I mean, it's kind of like a flow chart, but um, you can see that if you fail one of these tests, then, then no dependency exemption uh, is met. So, was it your child? Yes. Did they live with you? Yes. Were they under 19? Yes. Uh, were they not filing a joint tax return of their own, which is a difficult situation. I'll come back to that in a minute. Are they a U.S. citizen or a resident of the U.S., Mexico, or Canada? In which case they would still qualify as a dependent. And then did you provide more than half the support? And if you can answer yes to all of those questions, then you have a qualifying child, which will be a dependent and may lead you towards also the child tax credit, the additional child tax credit, and possibly some educational credits if they were a student. So let's follow up here with a couple of items. This joint return test, um, the person cannot be married basically. So if you have a child that's say 16 to 23 and they would otherwise be your dependent, but they're married and they're filing a joint return with their spouse, then they're bumped off of your return. And most of the time that's a pretty clear cut issue. And then the U.S. citizen or resident of the U.S., Mexico, or Canada is kind of an interesting one. It's just an arrangement in the tax code. And so if you have a child but they're not a U.S. citizen, you might be, but they live in I don't know where to pick here, but let's say they live in I'll pick a Central American country, El Salvador or Guatemala or Honduras or Costa Rica. I guess I'll pick more than one. Then they may otherwise meet all of the tests and they would be a dependent otherwise, but they fail the test of being a U.S. citizen or a resident of one of those three, the U.S., Mexico, or Canada, assuming that they're not residents. So you'll find more about these filing status and these tests, both in your text and also if you go to publication 17, I think it's the second or third chapter. It begins on about page 20 of Pub 17, where there is a great discussion of these tests and more detail about them. Now, a qualifying relative by default is not a qualifying child, so we prefer to try to get dependents into the qualifying child realm because it's more advantageous, because it's an easier test, and two, it's going to provide the potential for additional credits that a qualifying relative would not make you eligible for. So they need to be related to you. There's a gross income test, which basically means that their gross income must be under the exemption amount for that year. So in 2016, their income must be under $4,050. And so this is the very hard part of the test that is often failed by most qualifying relatives, that prevents them from being a dependent. They might live with you. They live with you the whole year. You provide more than half the support, but they have some source of income that's not an excluded source of income that's just too high, and you're not able to claim them as a dependent. And so that test, the flow chart looks something like this. That you have to meet the relationship test, or they're a member of your household. gross income, and you can see in this slide here, it's an old slide, 2007. The exemption amount in that year was $3,400. For 2016, it is $4,050. And of course, the exemption amount is indexed for inflation, and so changes a little bit every year. You have to provide more than half the support. They're not on a joint return with somebody else. And then once again, the residency or citizenship test. And if you can answer yes to all of those, the most difficult one being the gross income test, then you can have a qualifying relative, which can be a dependent also. Here's a table that we won't go into great detail here with. I'd strike that. We won't even go into detail at all. But Table 3.1 from Chapter 3 of Publication 17, put out by the IRS. Pretty good summary table. Lots of times when you're reading the paragraph text in Pub 17, it can get a little bit dense at times, and sometimes you're looking for an overview, and this is not a bad overview. And again, for those of you that want to come back, you could look at the slides again, or you can go to Pub 17 and check out that information. And so here I've just highlighted the 4005 and it's all incomes not exempt. So for example, Social Security might, if your income's low enough, in this case it would need to be very low under the 40050, but if the person's only source of income is Social Security, then that would not necessarily be taxable income, and so it would be excluded for the purposes of calculating the 4050 threshold. So finally, we get to multiple support agreements. So this is kind of a difficult situation. I'm going to give you a fact pattern here, or a set of circumstances that describe what we're trying to do in this particular part of the tax code. So suppose that you have some parents who are have just one child who is, let's make this child Johnny, and he's 8. And one night, while Johnny's at home with the babysitter, the parents are out, and they become deceased in a horrible car crash. Well, we can all agree that that's a very sad and difficult situation. And what can happen in a situation like that is the family is going to do a variety of things to try to look at or try to take care of Johnny. And so Johnny is going to go live with his aunt, who happens to be raising kids that are of a similar age, and that seems to be the best fit in terms of a home for him, where he's likely to adjust as well as possible to the new circumstances, and he's relatively close to his cousins, and so that just makes sense. But Johnny's aunt is not very well off, and so the grandparents are going to chip in a big chunk of money to try to help make this happen. And Johnny also has an uncle who's, he's a Wall Street tycoon kind of guy, and he doesn't really even know Johnny, but he has a guilty conscience, and he can throw money at the problem, and so he's going to do that. Sorry, Wall Street guys, make you sound bad there, but you earned that reputation, honestly. So what you have is you have nobody providing more than half the support. And so technically nobody's meeting the support test, so nobody can claim Johnny as a dependent. And so we don't want that to happen. We want somebody to be able to claim Johnny as a dependent. And so in this situation, you can file Form 2120, and anybody who's providing more than 10% of the support can take Johnny as a dependent. And basically the parties are listed, and who's going to take the dependency exemption is listed there. So that's what a multiple support agreement is designed to do, and that's kind of how that is done. Now I'm going to jump back here to a slide we looked at earlier. So we've talked a little bit about how you meet the definition of one of these filing statuses, car racing by here. And so you check the box for the filing status, And then you also list your dependents here. Whoa. So down here, sorry about this, slideshow's jumping around here. In the exemptions part, you would list these dependents. And so your people that are meeting the qualified child test, the qualifying relative test, you look at those tests, you say, okay, we meet all of those, so we have a dependent. Most of the time it's fairly clear, right? You have a married couple with a couple of young kids. You don't look at the tests, they're just like, those are qualifying child. But when you're unsure, because you're not, the situation is not quite as clear cut, you go back and you review the rules and the tests and you make sure that you meet them. And then the dependents are listed, and you get an exemption for yourself and then one for your spouse if you're married filing joint. And then let's say you have two dependents, and so that would get you to a total of 4 dependency exemptions. And so you would get the married filing joint standard deduction of $12,600, but you would also get a deduction for $4,050 times 4, so $16,200. So basically the $12,600 and the $16,200, I'm thinking that's $28,800, would not be subjected to income tax at all. So these filing statuses and these dependency exemptions begin to shield income from taxation. And generally, households that have moderate income and young children in the household, between the dependency exemptions and credits, which we'll talk about next week in a couple of slideshows, have pretty low effective tax rates because they're having a lot of their tax obligation wiped out by these deductions and future credits. So that's kind of the start of thinking about taxes. It always begins with identifying people's filing statuses or filing status, and then the dependency exemptions, and then from that point it goes on to look at their income and their deductions. And so in the next slideshow, we'll probably start to focus in greater detail on gross income broadly conceived. So what meets the definition of income that's included and what types of income are excluded. But that's for next time. Thanks for joining us again, and good luck with your studies. Take care.